Good evening, folks. This is your ticker guy coming at you from Niceville, Florida. I want to talk to you today about illiquid assets. Let's first off start with what illiquid asset is not. It's not a stock, it's not an option, it's not normally a bond, it's not a futures contract. All of those things I can trade during market hours and quite frequently during the overnight hours, and I can do it anytime I want. In fact, right now, while I am recording this, the ES, or the S&P 500 mini futures on Globex, is being quoted at 809. At 809.25, I can buy, and at 809 I can sell. That is a 1/4 of 1 point difference. The market is liquid enough for me to go in and do that anytime I'd like. Now, there are trading hours during which that market is closed, and of course during that time the contract is illiquid, but the rest of the time it's open. Stocks are the same way. Wells Fargo, could be $11.15 by $11.20. Well, that's a 5-cent spread. Bid and offer. It's a liquid market. But what is this illiquid asset nonsense? Where's it all come from? Well, folks, let's look at your house, okay? Let's say that you think your house is worth $500,000. You try to sell it, somebody comes to put an offer on your house, and they write a contract for $250,000. Well, you think the house is worth much more than $250,000. The buyer obviously does not. You have an illiquid asset. You have a house, and you have a fundamental disagreement about price. So we've gotten to the bottom of this. All illiquid asset means is the buyer and the seller will not transact because they don't agree on the number. That's it. That's all it is. So how did it happen? Well, let's think about this, guys. Did illiquid mortgage-backed securities and CDOs and all stuff, did that all come about organically, all on its own? Oh, no, no, no. The government actually created all of these illiquid assets. That's right. This was all done on purpose. You see, back in 2007, if you remember, we had the Bear Stearns blow up. The hedge funds that exploded that started this whole thing. And not too long after that, we had this thing called MLEC that was proposed by the Treasury Department. It was supposed to be a super sieve, a way to take all of this garbage off of banks' balance sheets and put it somewhere where it would be worth maybe more than the market said it was worth at that particular point in time. Oh, the banks thought this was a great idea. After all, the market said that these mortgage-backed securities were only worth 60 or 70 cents on the dollar. But the government was proposing to put together a structure where they would get paid 80 or 90 or maybe even 100. In other words, there would be no loss. Well, why would you sell something to somebody for 60 or 70 cents on the dollar if you thought someone else was going to come along and give you 85? You obviously would not. Therefore, these assets became illiquid. They didn't start that way. They became illiquid because of this intervention. And this intervention has continued. MLEC blew up because, well, we couldn't figure out how to price these things. No, that's no big surprise. The buyers and sellers have a very different opinion. And as time went on, we saw more and more of these kinds of proposals. After Lehman Brothers blew up, we had TARP. TARP was supposed to buy illiquid assets. But at what price? See, the buyers of these assets, and there are many of them, there are billionaires out there, there are hedge funds, there are private equity guys, they'd love to buy this stuff, but they think it's worth 20 or 30, maybe 40, 50 cents on the dollar. Depends on which particular piece. The banks, however, think that they have no reason to believe that the government's going to step back from this thing. In fact, they think they're going to keep throwing these proposals out there. And as long as there is a possibility that the bank will be able to get 80, 90, 95 cents, maybe 100 cents on a dollar, they're not going to sell to anybody for 60. They'd be out of their minds. Well, guys, it's a basic pricing discrepancy here. Nobody believes that the other side is going to blink. Now, let's take a look at the other side of this, too. The government has made proposals to do things that would drive down the price that the buyers would pay. For example, mortgage cram downs. Right now, a judge cannot cram down a primary mortgage. Now, I happen to think that we should change the law so that primary mortgages can be crammed down just like any other kind of debt. But the fact of the matter is that we don't know what the rules are. So if I'm a buyer of these assets, let's say I have $100 billion and I'd like to buy some mortgage-backed securities, and I go out and I analyze the cash flow of the ones I would like to look at and what I think their default rates will be, and I say, I think those things are pretty stinky, worth about 50 cents. Okay, well, about half of their original value. Well, now I got a problem. I have to add a risk factor for the government changing the rules in the middle of the game after I buy those assets and reducing their value. So are they really worth 50 cents? No, I have to discount that. And then I have to add yet more of a discount for uncertainty because I don't know what's going to go on. Folks, this market will not clear until the game playing stops. But do not think for a minute that this is private enterprise that is causing these problems. It's not. The government can tomorrow stop the problem with illiquid assets. All Tim Geithner and Barack Obama have to do is step up to the microphone and say, ladies and gentlemen, these are the rules. We're going to do X, Y, and Z, and we're not going to change it. This is how it's going to be for the next 18 months, 24 months, 5 years. Put a time on it. But whatever it is, make it date certain so that I can take a look at this and make it long enough that the maturity of these assets will be reached before another change can occur. You do that, the market clears immediately, because now if I'm a bank, I can say, you know what, 60 cents ain't that bad a price. It might be 50 tomorrow, but I can get 60 now, and I know the government is never going to pay 75. Ladies and gentlemen, this is a manufactured crisis. Yes, we have a problem with pricing in the market right now. Yes, we have a problem with illiquidity. Yes, we have a problem with all of these things that are going on. But in terms of these markets freezing, in terms of the credit market freezing, which is what everybody's screaming about and was the reason that we were going to go into Armageddon, it has absolutely nothing to do with business failures. It has absolutely nothing to do with any of that sort of thing. It doesn't have to do with Lehman Brothers going down. It doesn't have to do with Bear Stearns going down. It doesn't have to do with AIG going down. It has to do with one thing and one thing only, and that is that nobody believes that the government will set up a particular set of rules and then shut up and step back. And until that happens, buyers and sellers cannot agree on a price. It's that simple. If you want to see this stuff stopped, you have to get on the phone. You have to start yelling at Congress. And Congress people, if you're watching this, President Obama, if you're watching this, Tim Geithner, if you're watching this is the facts. These are not suppositions. These are the facts. I will not purchase stocks or any other kind of investment until and unless I can reasonably value what I'm buying. Neither will anybody else. I'm going to put a huge discount on anything that I might want to buy in the marketplace, including a house for investment purposes, because I'm afraid that you're going to come in there and jack with the market and damage my investment after the fact. Do I need any proof that you might do that? Oh, I got plenty. Fannie Mae and Freddie Mac, hello. You guys destroyed the value of preferred stock, which should have had preference over the common, but you trashed it. You have intentionally damaged the liquidity in this market. Intentionally. It's not an accident. It's a purposeful, conscious, intentional act. The economy will not recover until this is stopped. The stock market will not recover until this is stopped, and the credit markets will not recover until this is stopped. Whatever policy you're going to set, whatever rules you're going to make, the market will adapt to those. But you must make up your mind and then put a cork in your mouth, because until then, we're not going to see a solution to this problem. Have a good evening.